So hello and welcome to the Property Sale Tax in Thailand webinar. I'm your host, Carl Turner from ExpaTax Thailand. The purpose of the webinar is just to explain how overseas properties that are sold and then remitted into Thailand are taxed. If you do have any questions, feel free to put them in the Q&A box and we'll get through to them at the end. So in this presentation, we'll go through the different rules for how pensions are actually, how properties are actually taxed. We'll go through the different methods that you can use to calculate the capital gains. And we'll explain the rules regarding CRS and how Thai revenue will know. We'll talk about tax residency and what the rule changes are. And then we'll go on to the Q&A. So who will benefit from watching this webinar? So anyone that's living in Thailand that's looking to sell a property overseas, or anyone that's looking to relocate and move to Thailand. These are two people that might be useful for watching this. If you've got any questions after watching this, you can go onto our Ask a Question section, the frequently asked questions. We've got hundreds of questions that we've answered for people. So a lot of the questions are on there. Quick disclaimer before we start. This presentation is purely for information purposes only. It does not constitute advice that should be acted upon in its entirety. So what's actually been announced? So with the rule changes, let's just go back to the basics with the Thai tax rules. They've changed quite dramatically over the last year. So there's three dates that are quite important. One was September 2023. This is when the first announcement was made for the rule changes. And this, all it meant was any overseas foreign sourced income that's remitted into Thailand. Before, the rules meant if you kept the money overseas for 1 year, one tax year, you could bring it in the next year and not have to declare on a Thai tax return. It's September last year that was announced that previous ruling was overruled and they went back to the original rule. In November, they actually announced something, which is the document on the right, which was that any cash in the bank pre-2024 is not classed as assessable income. And then the tax year started on the 1st of January 2024 with the new rule changes. So what's the current tax year? So it starts on, it's a calendar year, 1st of January until the 31st of December. And the last date to file paper-based is 31st of March 2025, or the 8th of April if you're filing online. So the Revenue Department, they've actually issued documents in July last year stating the new rule changes and how do foreigners pay tax in Thailand. And who does these new rules, who does it affect? What kind of visa status do these rules changes affect? So anyone who's in Thailand 180 days or more, they are classed as a Thai tax resident. Any types of visas, so permanent resident, married, smart, business, education, tourist, apart from the new LTR visa, which is excluded from foreign source income if you remit that income in the next tax year. So anyone who's in Thailand 180 days, unless they have the LTR visa, then they are taxed on income. If it's brought into Thailand, you can't leave it overseas for one tax year and then remit that in anymore. So how can the LTR help? So it's for high net worth expats. There's actually a royal decree on this. It's a 10-year visa. If you do get the LTR visa, then it means you can remit in the income the next tax year. So we've got a webinar on this. If you'd like, we've actually produced a webinar, Expat Tax. So if you look on our website, there's more information to see if that might be useful for yourself. So what are the 8 categories for income tax in Thailand? So you can actually see on there the common ones. So pensions are included on there, investments, rental property income, and property sale is Section 40, Part 8. That's where it falls under property sale and any other activity not specified earlier. So property sale is an assessable income and you are taxed on the gains if they are remitted. We'll go through that later. Let's go through what isn't taxable in Thailand. This is quite important. So if you don't remit in overseas assets, so transfer in overseas assets, keep them overseas, it's not taxable. It's not a worldwide taxation basis yet in Thailand, but this is likely to change. If you have cash in the bank as of 31st of December 2023, you can remit this into Thailand without any tax implication in the future. Inheritance, so overseas inheritance, if you receive that and remit to Thailand, that's not assessable income. Gifts, this is quite a complicated subject, but potentially not taxable. Loans are not taxable. And if you're a non-resident, so let's say you're not in Thailand for 180 days, and then you sell a property, then those assets can be remitted to Thailand anytime in the future because they were sold in a non-Thai tax year. So yeah, if you haven't made a capital gain with your property, so there's no gain, then you bring in original capital. That's not assessable income either. And if you sell the property and you don't bring the money in, that's not taxable in Thailand. Remember, it's only a remittance tax basis. So let's say you do sell a property overseas and you are a Thai tax resident. There are two methods that you can use to calculate the capital gains and taxable amount. First method is the most common. So what we do is we look at the sale price minus the purchase price and all the expenses. So any renovations that you can prove with invoices and confirmations, any sales costs like solicitors' fees or agent fees, things like this, then we calculate the taxable gain. The other method, a bit more complicated, depends on the amount of years that you've held it, and you get a deduction based on the number of years. So the longer you hold it, the less the deduction on there. We'll go through that later. So who has to file a tax return? Only if you have assessable income in the year, in the tax year, and you're in Thailand 180 days or more. We're focusing on property sales here. We've got a question at the end about rental income. So we'll answer a few questions on there as well. So the filing process is we only put down assets that are assessable income. So income in Thailand or things that have been remitted into Thailand. When do you need to file? So if you do need to file a tax return for any income that you've brought in, you need to get a tax ID number to start with. You can get that from your local tax office or via ExpaTax Thailand. We have a service for this to obtain this on your behalf, completely online. It takes about 10 minutes to fill out. We have to file at the end of the tax year, so we can file from the 1st of January to the end of April for this current year. We have a tax filing service all online. We have a client portal, so very simple to use. 3 levels of service depending on what kind of assets you are remitting, whether you have to claim tax credits or not. With this double taxation agreements, you pay tax elsewhere. So let's get on to double taxation agreements. So this is quite relevant if you're selling a property overseas. So what does a double taxation agreement do? All it does is it helps explain who has the taxing rights for certain assets. We do have dedicated webinars for this subject. So we've got a generic double taxation agreement webinar, and then we have ones for UK, US, Australia, Switzerland, Canada, South Africa. The purpose of the DTA is really just to divide the taxation rights, and it sets the rules about how assets can be taxed. The double taxation agreement takes precedent over local tax rules, so it depends what the DTA says. If it says something special, then overrules the domestic rules. So there are 61 double taxation agreements, and we've done the research on all of them. It's on our website. You can click on our website and find out all of the double taxation agreements. And just remember, it's the jurisdiction where your asset is based, not your nationality. So say you've got a property in Canada, you need to look at the Canadian DTA, not your nationality. So if you've got a property in Cyprus, for example, you look at the Cypriot DTA with Thailand. Like I mentioned, we've got DTA specific webinars on our website that might be useful for yourself, where we explain this in a lot more detail. Tax credits. So if you've paid tax on the property sale in another jurisdiction, depending on the double taxation agreement, you may be able to claim that capital gains tax to offset against tax in Thailand. So let's say you sell a property in another country and you've paid some capital gains, then you may be able to use the tax paid as a tax credit for the amount that you bring in. So that's how it works. You have to have a tax certificate to show the tax paid in the other jurisdiction. And we can only use the credit for the amount that you remit in. It's not on all the amount. So if you don't bring it all in, we can't offset all of the tax. So we can potentially offset. We have to look at the DTA specifically for your jurisdiction, property, and if there's any tax paid at source. So let's go through how property sales are taxed in Thailand. So there's a lot of information in line on the revenue department. We've done the hard work and explained this in simple English for people. If you've got any questions afterwards, feel free to get in touch. We're happy to help explain this in more details. So the announcement that was made in September last year, it actually means that if you do bring in, so you sell a property and you remit the assets into Thailand, the gains are taxable in Thailand. You do get allowances and deductions in Thailand. So we don't use the deductions and allowance in the other country or your home country. So whatever you bring in that is a capital gain, you do have certain deductions. The common ones are personal allowance and spouse allowance. If you're 65 or older, you get another 190,000 allowance, for example. And then once we've deducted off the allowances and deductions, then we get into the income tax brackets. So it is progressive, like most tax systems. The first 150,000 is tax exempt. And it goes all the way over 5 million Thai baht of income that's brought in. It's taxed at 35%. So it's a progressive tax scale. So like I mentioned, there are two specific methods that we can use. One is we have the sale price minus off the purchase price with all of the expenses. That's the taxable gain. And the other method, it depends on the amount of years that you've got with the deduction that you can get, but that's on the sale price. So it might not be the most favorable. It depends on your circumstances. So the easiest way to explain this is to go through a few case studies. So the first case study let's go through this. There's three specific ones. First one, American national, they sell a property in the US in 2023 when they are a non-Thai tax resident. So they were less than 180 days in that year when they sold the property. Then this current year, they've spent 181 days in Thailand, so they're a Thai tax resident, and they decide they want to remit, so transfer in 5 million Thai baht from that sale. And the property's made a 50% gain. Now, because they sold the property in a non-Thai tax year, it means it's not assessable income. So if you sell a property as a non-Thai tax resident, you can bring that money in, as long as it's in cash, anytime in the future, without any tax implication, as the sale happened in a non-Thai tax year. So there's no reporting, no tax ID needed for that. So that's a very simple case I want to explain. Next one. So someone who has a property, doesn't really matter the country, so residential property. So whether that's in UK, Australia, US, wherever the property is, doesn't matter. We're assuming that there's no tax paid in the other jurisdiction because it's a residential property. They retired in Thailand, so they're over 179 days in the country, and they decide they want to sell the property in a Thai tax year. So I've put the figures in pounds and sterling because someone in the UK. So let's focus on the Thai baht figures. So they sell a property for 19.5 million Thai baht. and they paid 13 million for this 5 years ago. The costs to sell are 430,000 Thai baht. So this solicitor fees and agent fees, these can be deducted off. And they actually made renovations on the property worth 1 million baht over the years. So how do we calculate the gain for this situation? So what we do is we look at the sale price, two methods, but this is the first method. We look at the sale price minus the purchase price, and then we take off all of the other expenses. So the renovation costs and sale costs. So it's quite an easy calculation to do. So I'll talk through it. So it's 19.5 million. We take off the sale price and we add on all of the expenses as well. So it reduces down that capital gain. So if you sell a property with this method, it means if you sold it for 13 million and you had the expenses of the renovations and the costs to sell, it means the capital gains in this example would be 5 million Thai baht in total. That's the assessable income if it's remitted into Thailand. Now, there are some things that people could do. So they could sell the property in full, that have the capital gain, assessable income of 5 million baht. They could split that over 2 tax years, so they could bring in half now and then bring in half next year. So they could split the amount that they bring in. So that would reduce that taxable amount to split over 2 tax years to reduce down. Or if they just decided they want to bring in half of the amount that they received, then we'd obviously half the amount of assessable income. So let's calculate if someone brought in 3 million Thai baht from that. So they sold the property for 19.5 million. We take off the purchase price and all of the other expenses. What we need to do is calculate the capital gain. So in this example, it's a 26% capital gain. So how we calculate the actual capital gain amount that we put down on the figure, if we brought in 3 million Thai baht, what we do is we put the amount that you bring in, we divide that by 1 plus the capital gain percentage. So if you bring in 3 million Thai baht from, in this example, the original capital will be 2.3 million and the actual gain would be 619,000 Thai baht. So it's just a way to sort of explain how much the tax would be in this example for bringing in 3 million baht from that property sale rather than bringing it all in. If we bring it all in, it's pretty obvious it's 5 million Thai baht. So then we look at the tax tables. We take off the allowances and deductions. So there's 310,000 of allowances and deductions for this example for a 65-year-old who's married. And so we look at the 619,000, which is the capital gain amount that brought in from that 3 million. We deduct off the allowances and deductions, and then we use the tax table. So in this example, if they brought in 3 million Thai baht from the sale of that 19.5 that they received, after taking off the original purchase price and expenses, if they brought in 3 million baht of that, then the tax they would actually pay would only be 8,405 baht. So it's quite low. It's not as bad as what people think a lot of the time. Now, we do actually help people with the calculations. If you'd like a free tax calculation session, you can book in a time to chat with one of my colleagues. We're here to help you understand how this will actually look in principle for your own circumstances. So let's go through another case study. So let's go through the same example, but we'll use the other method. So sometimes it's more beneficial to use that, but let's just explain that in general terms. What would the capital gain be if we used the other method? So with the other method, we look at the sale price, and then we can deduct off a set percentage depending on how many years you've had it. So this example, they sold the property in 2008. So they've had it for Yeah, that shouldn't be 2008. It should be 5 years. So 2018. So basically, they've had the property for 5 years when they sell the property. So what we do is we look at the tax tables. 65% we can have as a deduction. They sold the property for 19.5 million. We times that by 65%. So the amount of deduction is 12.6 million. So the taxable gain is 6.8 million. So for this method, this example, we wouldn't use this method, because if we use the first method, the tax would be less because of the deductions that they get. So it would only be 5 million. So it's just an example of how you can use this specific method if you've got 5 years, if it was held for 5 years. Like I mentioned, if you'd like to book in a free call to go through the tax calculation, colleague Jason is available. We'll send out the link with the email with this video, or it's in the description if you're watching this online. We also offer tax consultations, so to go through your circumstances in more detail and help with things like tax planning and planning when you do disinvest assets. So let's talk a little bit about how will Thailand actually know what is common reporting standards, what information is actually already being sent. So Thailand actually signed up to common reporting standards in 2020. And it's something that actually started in 2016. There are now 120 plus countries that have signed up for common reporting standards. And it's to stop tax avoidance. It's a global initiative. And it means that all of the revenue officers share the data for all of the tax residents that have assets in other jurisdictions. So if you have bank accounts, credit cards, investments, pensions, insurance-based investment products, then all of the information is being sent to the local revenue office. And then every year that is compiled and sent to the other jurisdictions where you are a Thai tax resident. So the Thai Revenue Department receives that data every year in an XLS file for all those types of assets. So if you sell a property, the assets go into your bank account. If the bank account is part of a CRS country, that information is already relayed to Thailand eventually via the revenue department of that country. So what are the implications of not declaring? It's actually 2 times the tax that's owed, plus 1.5% surcharge that can be charged. Like all tax authorities are quite punitively taxed if people don't declare. Yeah, so if you would like more information on this, we have a free tax calculator service that we mentioned earlier. We can arrange one-on-one consultations either online or in person. We can help people file tax returns. We do have a tax filing service. And if you do need a tax ID number, we can get that on your behalf. So we're here to help. If you've got any questions about your own circumstances, please let us know. We do have brochures and actual tax guides as well, online conversations that we can have. And really important, I think, is signing up for our tax alerts. So this is an email tax alerts and email updates for any changes to the Thai tax laws. So it looks like there will be further changes, and common reporting standards are actually pushing for Thailand to move to a worldwide taxation basis. So if you would like to be kept up to date with any further changes, feel free to click on the link on the email or in the description in the video and sign up to our tax alerts, where you will receive by email up-to-date information on taxes in Thailand. So let's get on to the Q&A session. Put a few questions in, and I'll go on to the questions that have been received on the call. So first question: will I need to pay UK capital gains tax if I sell property in the UK after moving to Thailand? Are there any exemptions, allowances for UK expats when selling property? what does the timing of my move impact the capital gains tax liability? Okay, so good question. This is around capital gains tax. So if you sell a property in the UK, for example, or you sell one, most jurisdictions are exactly the same. If you look at the double taxation agreement, most state that if you sell a property, they are taxable in that country where the asset is based, and they may be taxed in the other jurisdiction. What does that mean? It means, for this example, for the UK, UK has the first right to tax on the capital gains on the property if you sell a property, depending on how it's held, if it's a residential property or not. If you've paid capital gains tax and you remit to Thailand, then you can use the tax paid as a potential tax credit due to the double taxation agreement. So let's have a look at this example that we went through earlier. Let's say for this example, when we look through the tax calculation on the example for 19, so someone sold a property for 19.5 million Thai baht, and the taxable gain was 5 million Thai baht. If there was tax paid on that in the UK and they brought all the money into Thailand, we could deduct off the capital gain tax paid on that from that 5 million Thai baht. So that's how it's essentially calculated. Then we use the Thai allowances and deductions for that. Next question. Okay, we've had a few questions in regarding rental properties as well. So let's just explain this. So I have a property in Thailand and I rent it out, but I don't live in Thailand during the year that I rent it out. Do I need to file a tax return or do I need to pay tax on the rental income? Yes. So if you have a Thai rental property, regardless if you are living in Thailand or not, it is Thai sourced income. So you have to file a tax return, a PND 94, half-year tax return, and an end-of-year tax return, regardless if you're in Thailand or not. It's the same rule for most countries. If you have a rental property, then you need to declare the tax in that jurisdiction. And then depending on where you live in, you may have to pay tax elsewhere as well, depending on the rules there. So let's go on to the other questions that we've received in. I'd like to know about the taxation rules if I sell my condo here as an expat in Thailand. So these rules apply. Yeah, it's slightly different in Thailand, depends how it's held, whether it's in your name or not. So the rules are very similar in terms of the taxation for domestic or overseas. But today we're focused on the overseas. And there's some tax plan people can do. So it depends on when they sell the property. That's really important. If they need to sell a property overseas, if they are a Thai tax resident in the year that they sell, then it means any time in the future that that's remitted into Thailand, they are taxed as assessable income if it's remitted. If they sell it in a non-Thai tax year, then it's not assessable income. Also, if people have the LTR visa, this may be useful for certain people because if they sell a property overseas, they have a gain, they could remit that in the next tax year and not have a tax implication. So yeah, I hope that's been useful. If anyone has any questions regarding their own property or selling a property, get in touch and we're here to help. I hope that's been useful to just give you an explanation about how capital gains actually works and remitting in the assets to Thailand. So thank you for your time. Hope that's been useful. Feel free to reach out if you have any questions. Bye-bye.